Good morning, this is your Morning Jolt. I'm Jacob Sonnenschein.
Is that FEMA?
All right, banks are in the middle of reporting earnings and tech earnings are coming up soon. So a lot of really good strategies you should be aware of coming down the pipe. I'm going to start with Bank of America. Bank of America just reported earnings, and the bank earnings in general have looked pretty good. And net interest margins are expanding. Loan volumes for now are okay. But what are we looking at ahead? Or maybe we should be a little bit wary of bank stocks?
Yeah, so me and Jeff, we were talking with Jim about this all morning. You know, it was good numbers. JPMorgan also had good numbers. Citibank was out good. The problem that we're seeing right now is the financials are just not getting enough credit. So basically, we know that the Fed is coming out pretty hawkish. They're already guiding for another rate hike this year, 3 more next year. The thing that everyone's worried about is that the Fed is going to misstep, and that has historically a misstep by the Fed is something that can bring us into a recession. So the concerns right now are the end of cycle concerns, which is what the Fed is signaling. So even these fantastic bank earnings are just, they're not enough to get people to stop worrying about the end of cycle concerns. And that's exactly what we saw when JPMorgan reported, and Jamie Dimon was saying a lot of these current tailwinds could turn into a headwind if the Fed is he didn't say it directly, but if the Fed is too aggressive.
And if we are at the peak of the economic cycle, and you have rising interest rates, and the Fed is going to bump up interest rates a few more times still, right? If that's the case, then are we afraid of, maybe when it didn't show up in the bank earnings just yet, but are we afraid the next quarter, the next 2 quarters, loan demand coming down a little bit?
Yeah, exactly. So, I mean, you know, obviously the higher the rates go, the more expensive it becomes to borrow money. Money becomes more expensive, and so people are going to want to borrow less of it. What is that? That's directly, we're talking loans. They're going to want to take out less loans. So right now, the economy is strong. We can handle the rate hikes. People are still borrowing. You know, I think I saw there was still mortgage growth over at Bank of America. But if we keep down this path with the Fed hiking rates on the short end, rolling off its balance sheet, potentially pushing up the 10-year, which is going to in turn make mortgages, which just hit about 5% more expensive. All of that is kind of what Jamie Dimon is worrying about and what the market is worrying about. End of cycle, less loan growth, and all of that has to do with the fact that the Fed has so far not walked back its hawkish stance. I mean, if we do see Jerome Powell come out a little bit more dovish, I think we could see a rally. We could move, take another leg higher, bounce back to where we were. But for right now, when it comes to the financials, the Fed is the focus.